Profit from drift. This simple phrase captures the essence of a rather useful options strategy. It means we aim to make money when a stock's price doesn't make a dramatic move, but instead drifts sideways or gently moves in a predictable direction. This particular strategy is known as a short combo, a way to seek capital gains without guessing a big price swing. It involves setting up a position with a very specific risk and reward profile. Many traders like it because it can be tailored to their view of a stock's future. The core idea: benefit when a stock either falls or stays relatively stable. You are setting up a trade with a bearish or downward bias. It also has a component that generates income to offset cost. A directional bet plus an income-generating element. That's why options are versatile. The short combo combines two options into one unified position. It's considered a capital gain strategy. Profit comes from option value changes. Close for a profit, and that profit is a capital gain. Not a pure income strategy like selling covered calls on stock you already own, because you are also buying an option. Goal: see the combined value of your two option legs move in your favor, so you can close for more than you paid, or for a larger credit than you initially received. This strategy carries risk. We aim for profit from a drifting or falling stock, but a strong, unexpected rally can cause big losses. So understand the potential for profit and the exposure to risk before trading. We'll keep this simple and clear so you grasp the fundamentals. This is a journey of understanding, and every step is important. A short combo is constructed using two distinct parts. In the world of options, these are called legs. The goal is to combine these two legs to achieve our desired outcome. The first leg involves buying a put option. When you buy a put, you are purchasing the right, but not the obligation, to sell a stock at a specific price, known as the strike price, on or before a certain date. This part of the trade profits if the stock price falls below the put's strike price. It acts as our bet that the stock might go down or as a form of protection. The second leg of the strategy is to sell a call option. When you sell or write a call option, you are receiving a payment, called a premium, from a buyer. In exchange for this premium, you take on the obligation to sell the stock at the call's strike price, if the buyer chooses to exercise their right. This leg of the trade profits if the stock price stays below the call's strike price. The premium you receive from selling the call helps to reduce the overall cost of setting up the entire position, which is a key benefit of this structure. A critical rule for this strategy is that both the put option you buy and the call option you sell must share the exact same expiration date. This ensures that both parts of your trade conclude at the same time, simplifying the profit and loss calculation at the end. If they had different expiration dates, managing the position would become far more complex, as you would be dealing with different rates of time decay and risk profiles. The shared expiration date synchronizes the two legs into a single cohesive strategy that can be analyzed as one. While the expiration date is the same, the strike prices for the two options are different. Let us make this concept much clearer by using a real-world example with a well-known company, Amazon, ticker AMZN. Imagine Amazon is trading at $150 per share today. We think it might drift downwards or stay relatively flat over the next month. So we choose a short combo strategy. We'll use options that expire in 1 month. First, execute the two legs. Buy one AMZN $145 put. This gives us the right to sell 100 shares at $145. Put premium $3 per share. Cost $300. Sell one AMZN $155 call. That creates the obligation to sell 100 shares at $155 if exercised. Call premium received $2 per share. Credit $200. Both options share the same 1-month expiration. That completes the short combo on Amazon. We bought a put to profit from a potential downward move, and we sold a call to generate income and reduce the overall cost. Strikes of $145 and $155 form a $10 channel around $150. The trade is now active. Final outcome depends on where AMZN is at expiration in 1 month. Now that we have established our example trade on Amazon, we need to calculate the initial cost or credit of the position. This is a very important step. It determines our maximum loss if the stock stays between our strikes, and it is a key component in calculating our final profit or loss. The calculation is quite straightforward. We simply look at the money we paid out and the money we brought in. In options trading, a net cost is called a net debit, and a net income is called a net credit. In our Amazon example, we performed 2 transactions. First, we bought the $145 put option for a premium of $3 per share. Since an options contract controls 100 shares, this represents a cash outlay of $300. This is the cost of our protection. Second, we sold the $155 call option and received a premium of $2 per share. This brought in $200 in cash. This is the income we generated to help finance the position. To find the net result, we subtract the money we received from the money we paid. The cost to buy the put was $3 per share, and the credit from selling the call was $2 per share. So the net cost is $3 minus $2, which equals $1 per share. This means we paid a net $1 per share to enter the trade. Since one contract covers 100 shares, the total net debit is $100. This $100 net debit will be immediately removed from our trading account's cash balance when we place the trade. It is the price we pay to establish the position. It is also important to note that this specific trade resulted in a net debit. However, depending on strike selection and stock volatility, the premium from selling the call can exceed the premium paid for the put. In that case, you would have a net credit trade where you receive money up front to open the position. Placing the short combo trade in your brokerage account is a process that requires care and attention to detail. And it is not as simple as just buying a stock. Here is a clear step-by-step guide to follow. The first step is always to select the underlying stock you wish to trade. For our example, we have already chosen Amazon, AMZN. You should have a clear reason for choosing the stock, such as believing it is unlikely to rally strongly in the near future. Research and a clear thesis are your best starting points. Next, you must choose your expiration date. This determines the time frame for your trade. Shorter-term expirations, such as 1 month, mean that time decay will be faster, but it also gives the stock less time to make a big move against you. Longer-term expirations give the trade more time to work out, but are generally more expensive. For beginners, choosing an expiration of around 30 to 45 days is often a good starting point, as it provides a reasonable balance. In our example, we chose an expiration of 1 month. After selecting the date, you must choose your strike prices for both the put and the call. As we discussed, you will buy a put with a strike price below the current stock price, and sell a call with a strike price above it. The distance of these strikes from the stock price is a critical decision. Choosing strikes closer to the money will result in a lower net debit, or even a net credit, but it also increases the risk of one of the options ending in the money. Wider strikes are more conservative but will cost more. In our example, we chose the $145 put and the $155 call. Finally, you will place the order. It is highly recommended to enter this as a combo or spread order in your brokerage platform, not as 2 separate trades. This instructs your broker to fill both legs of the trade simultaneously and at a specified net price. For our example, you would place an order to buy the $145 put, sell the $155 call, for a net debit of $1. This ensures you do not end up with only one leg of the trade filled, which would leave you with a completely different and unintended risk profile. Always double-check your order before submitting it, Section 6. Managing your position. When to exit the trade. Once you have entered the short combo trade, your work is not finished. Active management is key to controlling risk and securing profits. You should not simply set the trade and forget about it until the expiration date. It is wise to have a clear plan for exiting the trade before you even enter it. This plan should include rules for taking profits. Cutting losses. A predefined exit strategy removes emotion from your decision-making. One common approach is to set a profit target. For instance, if you paid a net debit of $100, you might decide to close the trade if its value turns into a credit of $50, representing a 50% return. Another way to manage a profitable trade is to exit if the stock makes the move you anticipated. If Amazon's price drops towards your put strike of $145, the value of your position will increase. Closing the trade at this point allows you to lock in those gains before the stock has a chance to reverse course. Equally important, if not more so, is having a rule for cutting your losses. The biggest risk in this strategy comes from the short call option if the stock rallies strongly. If Amazon's price begins to rise and moves above your short call strike of $155, your losses will start to mount quickly. You should have a predetermined point at which you will exit the trade to prevent a small loss from turning into a catastrophic one. For example, you might decide to close the position if your loss reaches 100%, 150% of the initial debit you paid. There are two primary ways to exit the position. The simplest method is to close both legs simultaneously. To do this, you would place a combo order to sell the put option you bought. Buy back the call option you sold. This completely flattens your position. A more advanced technique is to roll the position. This involves closing your current options, opening new ones with a later expiration date. This can be used to give your trade more time or to adjust your strike prices. For those new to options, simply closing the trade is the most prudent and straightforward exit method. Profit and loss scenarios. The three main outcomes. Section 7. Profit and loss scenarios. The three main outcomes. At the expiration date, the final profit or loss of your short combo trade will be determined by the closing price of the underlying stock. We can break this down into three main scenarios using our Amazon example, where we paid a $1 net debit to enter the trade. $145 strike. $155 strike. Understanding these scenarios is fundamental to grasping the risk and reward. The math is simple and it clearly illustrates how the position behaves. Let us walk through each possibility one by one. First scenario. The best case outcome. The stock price falls significantly. Let's imagine that at expiration, Amazon stock has fallen to $140 per share. The $155 call option you sold expires worthless. The $145 put option you bought is now in the money by $5. 145 minus 140 equals $5. Your profit is this $5 value minus the $1 net debit you paid. This gives you a net profit of $4 per share, or $400 per contract. The further the stock falls, the more profit you make. Second scenario. If the stock price remains between your two strike prices. For instance, if Amazon's stock closes at $150 per share on expiration, the price is below the $155 call strike and above the $145 put strike. Both the call you sold and the put you bought will expire worthless. Since both options are worthless, you do not make any money back. Your loss would be the full amount you paid to enter the trade. The $1 net debit, or $100 per contract. This is your maximum loss, provided the stock stays within this range. Third scenario. The worst case outcome. The stock price rises significantly. Let's say Amazon stock rallies to $160 per share at expiration. The $145 put you bought expires worthless. The $155 call you sold is now in the money by $5. 160 minus 155 equals $5. Because you sold this call, this $5 represents a loss to you. Your total loss is this $5 per share plus the $1 net debit you initially paid. This results in a total loss of $6 per share, or $600 per contract. Crucially, because you sold a naked call, your potential loss is theoretically unlimited if the stock continues to rise. Summary: profit if stock falls, small loss if between strikes, growing loss if stock rises. Practical rules to reduce your risk. Engaging in any option strategy requires a disciplined approach to risk management. The short combo is no exception. Unlimited risk comes from the short call leg. Fortunately, there are several practical rules to mitigate that risk. Rule 1. Use a small position size. Never risk more than you can comfortably lose. Beginners, consider trading a single contract until you gain experience. Rule 2. Always use stop-loss orders or alerts. Have a predefined exit if the trade moves against you. If the stock rises past your short call strike, your thesis may be wrong. Do not hope. Stick to the plan and close the position. A small realized loss beats a large open-ended one. Rule 3. Monitor major company news and events, earnings announcements, new product launches, regulatory news. These events can cause dramatic, unpredictable moves. The short combo is for drifting, not explosive moves. Often close positions before major scheduled events like earnings. Finally, consider implied volatility, IV. I4 measures the market's expectation of future price swings. High IV makes option premiums expensive. You pay more for the put and receive more for the call. High IV can give net credit, but signals expected large moves, which conflicts with the drifting thesis. Prefer trading when IV is moderate or low for a better risk-to-reward setup. Summary and your next steps. In summary, the short combo is a versatile options strategy designed to profit from a stock that drifts sideways or moves downwards. It is constructed with two legs. You buy a put option, you sell a call option, same expiration date, different strike prices. This combination typically results in a net debit, which represents your initial cost and your maximum risk if the stock price finishes between your strikes. Your maximum profit is achieved if the stock falls significantly, while your maximum loss is theoretically unlimited if the stock rallies strongly. We walked through a clear example using Amazon stock, select strikes, calculate the net cost, and understand the potential outcomes. The key to this strategy lies not just in setting it up correctly, but in managing it actively. This means having a clear plan for taking profits, and most importantly, for cutting losses if the trade moves against you. By following practical risk management rules, such as using small position sizes and avoiding major news events, you can use this strategy in a more controlled and disciplined manner. If this strategy interests you, the next logical step is to continue your education. Do not rush into placing a trade. Instead, take the time to study further. You can use a paper trading account, which is a simulated trading environment offered by most brokers, to practice executing and managing short combos without risking any real money. This allows you to become familiar with the mechanics of the trade and to see how it behaves in different market conditions. Your journey into options trading should be a marathon, not a sprint. Start with the basics, master one strategy at a time, and always prioritize the protection of your capital. The short combo is just one of many tools available to an options trader, and understanding it thoroughly is a valuable step in building your overall knowledge. Continue to learn, practice with caution, and build your confidence slowly and steadily. That is the most reliable path to long-term success in the markets. Thanks for watching and good luck with your trading. See you next time.